Okay, so, we're all about bringing our listeners the most interesting stuff that we're reading, and I think you shared a really interesting one recently.
Yeah, absolutely. This is the Macro Butler.
Yeah.
When Trump trades meet Trump tariffs.
When Trump trades meet Trump tariffs is the title of this newsletter. So we're going to dive into that and just sort of break down, what's it all about? And more importantly, what does it mean for you as an investor?
Exactly. And I think one of the really cool things that this newsletter introduces is this concept of a trumped trade. And a trumped trade, you can think about it as when a good trade uh, becomes outperformed by an even better trade or an even better opportunity. And we're going to talk about that specifically as it relates to this idea that there was all this excitement early on, right when the new administration took office about what this would mean for certain assets and investments. And now it seems like that's kind of running headfirst into some of the new policies coming out, especially with tariffs and trade.
Right. And so speaking of those big narratives that everybody's talking about, the Macro Butler highlights two. The first is obviously tariffs, and the second is this sort of really interesting Department of Government Efficiency, which is apparently led by Elon Musk or DOGE. And so,
JOGE, yeah.
we're not going to focus on that one today because it seems like something out of, a satirical novel. But we're going to focus on tariffs, which seems like it's going to have a pretty immediate impact on your portfolio.
Yeah, and I think, we have to remember is that tariffs have been around for a very, very long time. So I
Yes.
think,
Like since the beginning of time. I mean,
yeah, you think about ancient empires, right? Think about the whole mercantilist era
right.
when countries have used tariffs for centuries to raise revenue, protect local industries.
Yeah.
So these things aren't new. But in the U.S., we had massive debates around tariffs, in the 19th century leading up to things like,
Yeah.
tariff of abominations.
Right. And then fast forward right to the Great Depression. I mean, the Smoot-Hawley Act, the Macro Butler really drives home this point that, these high tariffs, they made a bad situation even worse.
Yeah.
So if history is a guide, why are we seeing this resurgence now?
Well, I think one of the things that the newsletter highlights is that the immediate impact of these tariffs are really a surge in what they call trade policy uncertainty. And this idea that policies can shift so rapidly that investors and businesses are constantly in a state of unease.
Right. And it's not just this vague feeling of instability, right? I mean,
Yeah.
the Macro Butler actually put some numbers on this. They say that, by the end of this year, trade policy uncertainty alone could knock 1.5% off of world trade and 1.0% off of global industrial production compared to a world where, trade policy is stable. So we're talking about a real sort of, drag on global growth.
Absolutely. I mean, and you're seeing it in how consumers are feeling. I mean, the University of Michigan Consumer Sentiment Survey has plummeted to its lowest level since inflation peaked back in 2022. So people are clearly worried about what this means for their future. And, Macro Butler highlights that that's translating into changes in spending habits.
Right. And so taking a step back, what's the likely scenario, if this uncertainty continues, if this falling confidence continues?
Well, the newsletter kind of introduces this idea, or I should say reminds people about this idea of stagflation. And it's really important that you understand this. It's not just prices going up. That's inflation. Stagflation is when you have rising prices coupled with diminishing purchasing power.
Right. You're paying more for things, but your money is essentially worth less.
Exactly.
It's a scary concept.
And the newsletter really hits home this idea that there's this feedback loop. Low confidence makes businesses and consumers hesitant to invest, and that in turn fuels slow growth, and that keeps prices elevated. So it's like this self-reinforcing cycle.
Yeah, and it's interesting because when we talk about tariffs, the obvious question is who benefits, right? And the newsletter cites some OECD estimates that paint a pretty bleak picture. In a trade war, nobody really wins.
Yeah.
The OECD estimates that a 10% hike in U.S. tariffs met with retaliation from other countries could shrink the global economy by 0.3%.
It's just not a recipe for economic growth.
Actually, North America specifically would be hit really hard, right?
Yeah, absolutely.
Ah,
I mean, you're talking U.S. down 0.7%, Canada down 0.6%, and Mexico by a pretty significant 1.3%.
yeah.
And that's not even including that global inflation is expected to rise, and particularly hard in the U.S., 0.7%. So this idea that, tariffs are a simple win for American industries.
It's just wrong.
Yeah, exactly.
And it's interesting because the newsletter kind of zooms out a little bit and starts to talk about, how these U.S. tariffs are reshaping global trade routes. And what's fascinating is it's not just about China's exports to the U.S. declining, but they're really rapidly expanding their trade with emerging markets.
Yeah, I mean, the numbers are quite astounding. They say that China's exports to emerging economies nearly doubled between 2017 and 2024. up from 32.5% to 42.3% of their total exports. Meanwhile, the U.S. share has been tumbling in key areas of growth, Mexico, the ASEAN nations. I think, it's really fascinating because the newsletter says that even with these higher tariffs, from the U.S., the overall impact to China's economy might be less severe than some analysts anticipate because the U.S., while it is a very important market, is no longer their dominant export destination.
Right. And so it's not just about, the direct impact on trade between the US and China, but it's this idea that, you could have almost like a trade war within North America.
Yeah.
And the newsletter says that that would actually be incredibly damaging because, Canada and Mexico's economies are so interconnected with the US.
Yeah, they represent a much larger percentage of U.S. GDP compared to our trade with China.
Yeah.
So sustained tariffs would almost certainly trigger retaliation and end up hurting businesses and consumers across all three countries.
Right. And so switching gears a little bit, the newsletter then gets into how these tariffs could impact the global financial system, and specifically talks about this trend of de-dollarization and currency fluctuations. So could you break that down for us?
Certainly. So the newsletter basically says as more countries in what they call the mercantilist global south,
Yeah.
essentially developing nations focused on building trade surpluses, as those countries look to trade in currencies other than the U.S. dollar, the demand globally for dollars generated through trade will decline. However, the amount of debt held in U.S. dollars will remain the same. And that dynamic, coupled with geopolitical tensions and some economic wobbles in some other major economies, could paradoxically lead to a stronger dollar against other fiat currencies.
So it's this idea that the dollar is going to get stronger as trade is sort of moving away from using the dollar. How does that work?
Well, I think part of it is, the uncertainty surrounding tariffs creates instability in foreign exchange markets.
Oh.
And the newsletter highlights, the JPM G10 one-month volatility index, which is ticking up, and that signals increased unpredictability. And we're seeing, this play out in how, various currencies are reacting to some of these trade tensions. And so this volatility, along with the increasing use of financial sanctions as a political tool, really ties into another point that the newsletter makes, which is the growing importance of gold.
Yeah. And so how do these all tie together?
Well, I think, tariffs are seen as another push factor in accelerating this de-dollarization trend and moving toward these regional currency arrangements. And in this environment of uncertainty, central banks are likely to add to their gold reserves. We've already seen a significant surge in the price of gold since late 2022, and this coincides with central banks increasing the proportion of gold in their foreign currency holdings.
So gold is kind of acting as a hedge or a safe haven against these sort of moves away from the dollar.
Exactly. And I think, the newsletter also offers a really critical perspective on the economic philosophy behind these tariffs. They suggest that it's rooted in outdated ideas about what gives a currency value. They mention things like currency backing the gold standard fiat versus gold. What's the newsletter's core argument there?
Yeah.
I think the core argument is that in today's world, a currency's strength is not tied to, its gold reserves or some historical peg. It's really tied to the productivity, the innovation, and the freedom of its people. And, they use examples like post-World War II, Japan and Germany, or even the U.S.'s, technological prowess during the Cold War. The dollar's global reserve status, it stems from America's dominance, in global trade, which these tariffs, they argue, actually undermine.
Right. So it's not about backing, it's about, the dynamism and the strength of the economy.
Exactly.
That's really interesting. And the newsletter also, touches on the geopolitical implications of the administration's stance toward groups like BRICS.
Yeah, and they argue that the U.S.'s somewhat confrontational approach to BRICS, initially aimed at countering Russia, has inadvertently strengthened alternative financial systems like China's CPS. I mean, BRICS has a significant global population, a perceived neutral political stance, and it's gaining some traction. And they also mentioned the increasing use of financial sanctions by the U.S., as another factor that could make holding U.S. assets, less attractive for some foreign entities and potentially increase the risk premium.
So we're talking about, consequences that are much greater than, just the direct impact on trade deficits and surpluses.
Right. Absolutely. And I think, the newsletter pulls all these threads together to paint this picture of what they call Trump's stagflation. And that's really the central thesis here, is that these economic policies are likely to contract the U.S. economy, potentially trigger a global recession, and usher in this period of, rising prices coupled with slow growth. And they point to the ratios of the S&P 500 to oil and gold to bonds as early warning signs. And they even mentioned that the S&P to gold ratio actually broke below its 7-year moving average on Inauguration Day.
Wow. So it's like a really stark kind of forecast here. And the newsletter doesn't shy away from, disagreeing with some of the more optimistic takes on tariffs.
Yeah.
Specifically, they mentioned Treasury Secretary Scott Bessent,
Yeah.
and his comments downplaying the inflationary impact of tariffs,
Yeah.
calling it just a one-time price adjustment.
And they strongly refute that. They argue that tariffs act like a tax that is embedded throughout the supply chain, and it can lead to a wage price spiral and squeeze corporate profits. And this is actually reflected in the fact that the S&P 500 earnings forecasts have been revised downward recently. So it seems like this is a much more pervasive and long-lasting impact than just a temporary blip.
It's not a one-time thing, right?
Yeah, exactly.
And so I think, trying to tie this back together, the newsletter really seems to suggest that this initial investment trend or strategy, which was known as the Trump trades, is now being undermined or trumped by, what they're calling the unfolding reality of Trump tariffs. So how do you see that playing out?
Yeah, so essentially the Trump trades initially favored, growth-oriented assets, NASDAQ, Bitcoin, the Magnificent Seven, the big cap tech stocks. And they were suggesting selling off the Dow Jones Gold Energy. And if you look at the performance chart that they included in the newsletter, it shows this complete flip. So the assets that were initially popular are now lagging behind the ones that were being sold. And this is, suggesting that the markets are, seeing a shift in sentiment as the implications of these tariffs become clear.
Yeah. And so given all this analysis, what kind of investment strategy does the Macro Butler recommend to navigate this potential Trump stagflation environment?
Well, I think, first and foremost, they emphasize prioritizing return of capital over return on capital.
Safety first.
Yeah, exactly. And they suggest leaning toward real assets like physical gold and silver,
Hmm.
highlighting, their historical role as a store of value, in turbulent times, and the fact that they have no counterparty risk.
Right.
They also suggest holding a diversified basket of other commodities to benefit from rising prices and then from managing cash. They suggest sticking with short-term, high-quality U.S. dollar-denominated bonds and T-bills to preserve capital while maintaining some liquidity within equities. They suggest favoring companies with low leverage, strong earnings growth, and healthy free cash flow, with an emphasis on energy and commodity producers over consumer companies. They also advise caution with companies heavily reliant on U.S. government revenue because there could be some austerity measures down the line.
Right. So it's really about, thinking about the long game and being prepared for a different economic environment.
Yeah, and I think, that's really the key takeaway from our deep dive into the Macro Butler's newsletter. This anticipated economic boost from these initial Trump trades seems increasingly likely to be overshadowed by the negative consequences of Trump tariffs, potentially leading us into this period of, Trump stagflation.
Right. And I think, understanding these potential shifts and these risks is crucial for every investor, regardless of, the size of your portfolio, the type of investments you're in. I think this is really food for thought. And so as we continue to see, the story unfold in the global economy, it makes you think about your own investment approach, right? Are the strategies that worked in the past still going to be the right ones going forward in this new landscape of trade and tariffs? I think it's definitely worth, taking another look at the Macro Butler's analysis and, thinking about how these potential shifts might impact your financial future.
Yeah.
Thanks for diving deep with us.